Cryptocurrency has revolutionized the way we think about money and investment, providing vast opportunities for profit in a decentralized and digital economy. However, the rapid growth of the crypto space has also attracted fraudulent actors who seek to exploit unsuspecting investors. These scams, ranging from Ponzi schemes to phishing attacks, have caused significant losses and damage to the trust in the crypto ecosystem. As a crypto investor, it is essential to be aware of the different types of scams in the crypto world to protect your investments and avoid falling victim to malicious schemes. This comprehensive guide will discuss the top scams in the crypto world, the tactics used by fraudsters, and how you can safeguard yourself from falling prey to these schemes. 1. Ponzi and pyramid schemes, a classic crypto scam. Ponzi and pyramid schemes are among the oldest and most infamous types of scams in any investment sector, and cryptocurrencies are no exception. These scams rely on new investors' money to pay returns to earlier investors, creating the illusion of a profitable venture. The operators of these schemes promise large returns on investment, ROI, with little or no risk, making them incredibly enticing. A. How they work. In a Ponzi scheme, fraudsters convince investors to put money into a supposedly profitable crypto venture, promising high returns with minimal risk. The returns are not generated from any legitimate business or crypto activity, but instead from the funds of new investors. As long as new investors continue to join and add more capital, the scheme can continue. However, once the flow of new investments slows down, the scheme collapses, and many investors lose their funds. Pyramid schemes are similar, except they also require participants to recruit new members in exchange for a commission. The scheme's sustainability depends on a constant influx of new recruits, and when recruitment stops, the pyramid crumbles, leaving late investors with massive losses. B. Famous examples. One of the most infamous Ponzi schemes in the crypto space was BitConnect, which promised users high returns by lending them Bitcoin in exchange for tokens on its platform. BitConnect was eventually exposed as a scam, and its collapse led to billions of dollars in losses for investors. Another example is the OneCoin scam, where investors were convinced to buy coins that had no real value, with promises of future profits from trading. It turned out that OneCoin was not a legitimate cryptocurrency, and the project was designed to defraud investors. C. How to protect yourself. Always be wary of promises of guaranteed returns or too good to be true investment opportunities. Research the project and the people behind it. Look for a credible, transparent team and a clearly explained business model. Avoid platforms that focus on recruiting others rather than providing a legitimate service or product. 2. Phishing attacks, the deceptive art of stealing your information. Phishing attacks are one of the most common and dangerous scams in the crypto space. Phishing refers to the practice of tricking individuals into revealing sensitive information, such as private keys, passwords, or personal details by pretending to be a trustworthy entity. A. How they work. Phishing can occur through various channels, including email, fake websites, and social media. Fraudsters will often impersonate well-known crypto exchanges, wallet services, or even celebrities. They may send emails or direct messages containing fake links to websites that look identical to the legitimate ones. And when users log in or enter sensitive information, it is captured by the scammer. One of the most common types of phishing is farming, where attackers redirect a legitimate website's traffic to a fraudulent site that looks nearly identical, often without the victim even realizing it. B. Famous examples: phishing scams targeting crypto wallets. Several incidents have occurred where fake wallet applications were created to steal users' private keys and drain their funds. For instance, a fake version of the popular MetaMask wallet was created, which, once installed, allowed attackers to steal users' private keys and subsequently their funds. Social media phishing scams. Fraudsters frequently impersonate crypto influencers, project founders, or platforms like Binance or Coinbase on social media, promising giveaways or free crypto in exchange for sending a small amount of cryptocurrency as proof of funds. In reality, the attacker just takes the crypto and never sends anything back. C. How to protect yourself. Never click on links in unsolicited emails or messages. Always manually type the URL into the browser. Ensure that the website you are visiting is legitimate by checking for HTTPS in the URL and looking for a padlock icon next to it. Enable two-factor authentication, 2FA, on your crypto exchange and wallet accounts for added security. 3. Fake ICOs, initial coin offerings, and token scams. Initial coin offerings, ICOs, and token sales are fundraising methods in which new crypto projects sell tokens to investors in exchange for funding. While many legitimate ICOs and token sales have helped launch successful projects, some fraudsters use these methods to raise money for non-existent or worthless projects. A. How they work. Scammers behind fake ICOs or token sales typically promise high returns on a new token that will rise in value once listed on exchanges. They often use aggressive marketing tactics to create hype and encourage investors to buy tokens at the pre-sale stage. Once the tokens are sold, the team behind the project disappears, and investors are left holding worthless tokens with no real value. Some scammers may even create a seemingly legitimate ICO, but have no intention of following through with the project. The website and white paper may look professional, but the underlying technology or use case may not exist. B. Famous examples, Centra Tech. The founders of Centra Tech ran a fake ICO, falsely claiming that they had partnerships with Visa and MasterCard. The ICO raised $25 million before the SEC intervened and charged the founders with fraud. Prodium. In 2017, a project called Prodium launched an ICO for a token associated with a banana. The ICO was a clear joke, but some people still invested in it before realizing it was a scam. C. How to protect yourself. Always scrutinize the white paper. A credible project will have a detailed technical white paper explaining the purpose, technology, team, and roadmap. Look for regulatory compliance. Many countries now require ICOs to register with financial authorities. Be cautious of projects that seem to operate in a legal grey area. Check the team's background. Verify the credentials and experience of the founders and team members. Scammers often hide behind anonymous profiles. 4. Rug pulls, when the developers disappear with your money. A rug pull is a type of scam where the developers of a cryptocurrency or decentralized finance (DeFi) project create a seemingly legitimate token or platform, attract investors, and then withdraw all the funds from liquidity pools or smart contracts. A. How they work. Rug pulls are common in DeFi projects where investors are entonces